To understand the scale of the global AI boom, you have to look at the single hardware choke point holding it all together. These pie charts show exactly who controls that choke point. TSMC holds roughly 70% of the overall foundry market and a staggering 90% share of all AI computing chips. Because of that grip on the market, they recently raised their 2026 revenue guidance to over 30%. This momentum stems from a projected multi-decade runway for artificial intelligence and high-performance computing applications. If you are tracking the AI supercycle, TSMC is the undisputed engine powering the entire operation. This chart reveals a massive disconnect. Despite projecting a 50% annual growth in AI revenue, TSMC's stock trades at $375, a 12% discount to its $428 fair value. Why discount a monopoly with this aggressive trajectory? Are investors irrationally afraid of heavily subsidized, state-sponsored competitors like Intel and Samsung catching up? Or are the company's massive capital expenditure requirements and macroeconomic vulnerabilities real reasons to keep your distance? To find out, we need to objectively evaluate the true costs of maintaining TSMC's wide economic moat and determine if this is a value trap or a genuine opening to buy high-growth dominance at a discount. TSMC has a structural advantage built into its business model. It operates strictly as a foundry. They do not design their own chips, meaning they never compete directly against their own clients. That pure-play focus allows them to use their massive scale to simply outspend rivals in research and development, constantly optimizing the power, performance, and cost of their manufacturing nodes. We can map out how this strategy pays off on this moat and margin scorecard. The massive R&D input translates directly into a wide economic moat, locking in returns on invested capital in the mid-20s, easily clearing their 8.2% cost of capital. But that scale requires an enormous volume appetite, bringing us to the primary trade-off: extreme client concentration. Currently, 22% of TSMC's total revenue comes from a single customer, Apple, thanks to a long streak of winning the manufacturing contracts for their A-series processors. And given the surge in high-performance computing, NVIDIA is on track to replace Apple as their largest customer within the next 2 to 3 years. If just one of those mega clients decides to shift their orders to Intel or Samsung, TSMC would immediately face a multi-billion-dollar revenue gap. Staying ahead of competitors means constantly pushing the boundaries of physics. Ramping up 2-nanometer and 3-nanometer chips requires continuous, massive physical infrastructure investments. Bringing our scorecard back, we see the next major input. TSMC's 2026 capital expenditure guidance has reached the upper bound of $56 billion. That is the exact price of capturing that 50% AI revenue growth. Right next to it is the corresponding trade-off: foundry cyclicality and a severe cash flow drain. Foundries inherently have to reinvest 30 to 50% of their revenue into CapEx every single year just to keep their technological lead. During a boom, they build aggressive capacity, but if the broader economy cools down, those brand new expensive factories sit underutilized, heavily dragging down overall profitability. To capture the upside of the AI boom, TSMC has to constantly drain its short-term free cash flow to literally outbuild its rivals. Then there is the most prominent risk hanging over the stock. TSMC's extreme geographic concentration in Taiwan leaves it heavily exposed to geopolitical shocks. To mitigate that, they are trying to diversify production by building new fabrication plants in Arizona, Japan, and Germany. These overseas expansions serve to appease Western political concerns and secure supply chains, despite construction and labor being more expensive than in Taiwan. Operating fabs outside of Taiwan is structurally more expensive to build and run, which creates a long-term pressure on their gross margins. There's also an immediate macro risk. Conflicts in the Middle East threaten the supply of liquefied natural gas, or LNG. That fuel powers both Taiwan's electrical grid and the global data centers driving the AI boom. If energy prices spike for an extended period, running power-hungry AI data centers becomes significantly more expensive, cooling down TSMC's primary demand pipeline. Because of this unique blend of high growth and high risk, TSMC is not a one-size-fits-all investment. Looking at this decision tree, we have to match the stock's financial inputs to your specific portfolio priority. If your priority is growth at a reasonable price, or GARP, This is a very strong match. You are buying in at a forward PE of 26 and a price-to-fair value ratio of 0.88. For that price, you capture a projected 20.9% top-line growth rate. But in exchange, you must stomach the cyclical dips of the semiconductor industry and tune out the noise of competitors trying to catch up. If you are an income and stability investor, this is a moderate fit. The company offers a steady dividend, uncut since 2004, maintaining a 50% payout ratio, projected to grow to 34 new Taiwan dollars by 2030. However, the current yield sits at a relatively low 0.89%, because massive capital must be prioritized for that $56 billion capex requirement. Finally, if you are a risk-averse macro investor, this stock is a clear pass. You should look elsewhere to avoid the stress of Taiwan-China tensions, global LNG supply shocks, and tightening U.S. export regulations. Buying TSMC is a calculated bet. You are wagering that their dominant manufacturing monopoly can generate enough cash to outrun their massive geopolitical vulnerabilities.